when you look at their financials, there are some questions about how these acquisitions have played out and whether they're going to fall to the bottom line, what synergies there might be with the business. Can you just give us a brief overview of how the revenue has grown over time and what's been driving that in recent years?
Yeah, absolutely. So the revenue has grown basically from a focus into in its two biggest segments. That is talent and representation, which you just mentioned. They have over 6,000 clients, $1.3 billion in revenue. That's 46% of their total revenue. And that segment generates $335 million in EBITDA. It's a word we're going to use a lot in this show. Listeners, as you know, earnings before interest, taxes, depreciation, and amortization. EBITDA is a good proxy for basically operating cash flow. So when you get a company this complex, which has a lot of maybe arcane adjustments in its accounting, some investors like to cut right to the quick and see, instead of net income or loss, what is that adjusted, or really the EBITDA number? They use an adjusted EBITDA number. We'll talk about that in a bit. So talent and representation, that's again 46% of revenue. They've also concentrated in this entertainment and sports segment. That's their second major segment. It's actually 63% of their total. Last year, that segment did $2.2 billion in revenue and had $439 million in EBITDA. Just looking at that sports, entertainment and sports segment for a bit, they specialize in distribution and sales. They're one of the largest independent global distributors of sports programming. And here's a stat that you brought to my attention. This one wowed me, Nick. They sell media rights globally in over 160 countries on behalf of more than 150 clients. One of those is the IOC, the International Olympic Committee. So there you have it. They also have a smaller segment. Their third segment is called Endeavor X. It's relatively new. And that segment did $66 million in revenue last year and $45 million in EBITDA. But let's talk about those financials. The company has had a really phenomenal growth rate when you take a look at revenue. So I calculated, this is a rough calculation, listeners. So if there's a real number cruncher out there, don't call me on this. It might be a percentage or two off. But I counted that the company has had a 29% compounded annual growth rate in revenue over the last 4 years. So in 2014, the company did $1.3 billion in revenue. That grew to $3.6 billion last year. They've done that through a combination of organic growth in some of the content areas, but through a lot of acquisitions, some of which Nick mentioned. Now, here's the rub. If you look at this S1 statement, this registration statement, Endeavor says, look, we did $3.6 billion in revenue, and we generated out of that some $552 million in adjusted EBITDA. But you hear that word adjusted. So they've taken a number which is already sort of adjusted. When you're looking at EBITDA, you are adjusting net income. You're taking away non-cash items like interest expense, depreciation and amortization, taxes. Some companies then adjust that number and want to remove other items that are typically one-time in nature. The problem that I've got with this adjusted EBITDA number is that it takes out a lot of items that are actually recurring from year to year to year on Endeavor's books. Stock compensation is one. Okay, that one maybe I can grant because that is a non-cash expense. In other words, when you put an expense on your income statement, when Nick and I run a business and he gets paid partially in stock, well, that doesn't really hit cash. So we can grant them that. But they're also pulling out numbers like merger and acquisition costs, restructuring costs, certain legal costs, and the like. The problem with this is if you look over their financials for the last 4 to 5 years, Endeavor is a serial acquirer, as I said. So they have ongoing restructuring costs every year. They have ongoing legal costs that are tied to acquisitions. They have ongoing merger and acquisition costs. So these are actually recurring items that should not be pulled out. When I sort of added these back in, I got that they actually generated $267 million in adjusted EBITDA with my sort of selective add backs. The problem with this is if you buy my argument that EBITDA is a rough proxy for operating cash flow, the company really doesn't generate a lot of operating cash. You can go to the cash flow statement. Last year, they only generated $121 million in true operating cash off of that $3.6 billion in sales. Their cash paid for interest bill last year was $267 million. So how are they supplying these deficits? And the answer is it's through their private equity investors. Yes, the company has borrowed a lot, but most of that's been tied to acquisitions. Where they're really getting funded is through about $2.3 billion in investments from Silver Lake, the private equity firm that I managed. And that is paying the bills for acquisitions. It's covering deficits. And now you, potential investor, are going to be asked to cover some potential deficits as well when this issue prices. So thank you for bearing with me. That was a bit of a long explanation, but I'd like to throw it back to you, Nick. What are your thoughts on that overview of their financial structure? Maybe you disagree with me on that analysis.
Yeah, I think there's clearly some concerns, with their debt. I think when you look at their EBITDA without adjustments, you're looking at about a 15x debt to EBITDA, I believe. So that's a pretty high multiple there. And so you really would have liked to see, with all these acquisitions over the past several years, to see some kind of scale kick in where you start seeing some returns on those assets. Those haven't started to play out. And when you look at the way their debt is structured, the repayment schedule on their debt begins to accelerate around 2022, 2023. So when you look at this business, really needs to start generating positive EBITDA, a positive cash flow to be able to support those debt payments in the coming years. Otherwise, it's just going to be an issue for the company. And so when you look at the issues with the debt, not having enough EBITDA to really support the payments, at least as things are constituted today, that comes back to maybe why the company is going public. And they mentioned that they're going to use the proceeds from their public offering to support working capital and corporate purposes, and may use it to pay down debt or to fund new acquisitions. When you look at Endeavor looking to use this IPO money to pay down debt, what are your thoughts looking at that as an investor, particularly when the debt and the EBITDA is a concern for the business today?
So it doesn't necessarily bother me if, as we're going to talk about in the second half of the show, there's a viable path to take this really phenomenal revenue growth and to get some orange juice out of those oranges. If you just take what's in the S1, it's hard to gauge because as of yet, we just have an initial S1 statement. So typically, listeners, you file your S1 and then a few weeks later, you'll file what's called an S1 amended statement, an S1/A, and then you'll fill in placeholder numbers. There are really not any placeholder numbers filled in. We don't know the expected pricing range, which tells us how much the company will raise. We don't know exactly how much would be allocated to working capital, how much to debt. Those numbers typically get filled in, and Nick will fill you in later in the show on why there hasn't been an S1 amended statement filed yet. But absent that information, it doesn't bother me if the company can make a persuasive case on, we'll pay down some debt, and here's how we're going to improve our margins and really capitalize on this great intellectual property we have, our vast footprint in the market. But that is for us to toss around in just a few minutes.